Welcome to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. Today, we've got a little bit of a tax special. We've got the brilliant David Woods from Active Accounting Group, and we're talking about the types of entities that property investors can utilise to purchase an investment property in. We're not focusing on superannuation today or self-managed super funds, but looking at personal names, discretionary trusts and companies. What are the advantages and disadvantages of each? How is tax impacted by the types of entities? And what's the difference between getting it right and getting it wrong? David makes a very complicated subject sound much simpler than it is. He has a real gift in that arena, but I think that you will also understand a lot of the complexity around it and why it's important to get it right. It's an awesome interview with David, and I'm sure you'll enjoy it. Here he is. David Woods, thanks for joining me on Geared for Growth.
No dramas, mate. Thanks for having me.
So we are in a tax special. Obviously, it's very important around the end of the financial year, but also for any property investor, getting the structure right is critical no matter the time of year. And as an expert accountant, couldn't think of anyone better to talk about the different structures that people will buy an investment property in. So can you run us through, outside of superannuation, which is probably a whole other episode, can you run us through the different entities?
Yeah, for sure, Mike. Definitely super's a beast of its own, so probably a separate podcast in that. But so I guess typically when people are looking to invest in property, they're looking at either purchasing property in individual names. That could be individually, solely in their name. It could be joint with a spouse or another individual. Alternative to that is purchasing property through, say, a discretionary trust. There's also a unit trust as well, so a fixed trust. And also companies can purchase property as well. So I guess in terms of that, there's some considerations, when I'm talking to clients around where they're looking, what their goals are and where they're looking to invest. Some of the things that might factor into those discussions are, is it a short-term hold? Is it a long-term hold? Because there's obviously short-term tax consequences as well as long-term tax consequences. And I guess what I mean by that is short-term, whether the property is positively geared or whether it's negatively geared, that will have a tax impact on sort of where that ownership lies. And then when you think about the long-term tax consequences, obviously you start thinking about capital gains tax as well. And, that's where that sort of short-term, long-term consideration lies, I suppose.
Yep. If we focus in on the individuals, you can have joint tenants or tenants in common, and I guess the most important differentiator there is sort of like a legal thing. It's the law of survivorship, right? Like if you and I went into it together, I could either have, if I was to pass away, it all go to you, or I could sort of say, well, I want it to go to somebody else. No offense, that's probably the way that I do it. You'll do it right. But when it comes to the tax advantages of buying in an individual name and the ability to have different percentages splits, what's some of the flexibility that buying in an individual name gives you from a tax point of view?
Yeah, for sure, Mike. So I guess, tenants in common, like you said, is, it's going to pass, it's 50-50. So, if I pass away and we get a property that's tenants in common and I pass away, it passes to you. Joint tenants gives you the flexibility to sort of structure it at a different percentage. So it allows, if you and I were to buy a property as joint tenants, I could own 90% of that property and you could own 10% of that property. Where that might be really useful or really tax effective is where you've got, a new husband and wife, or as the example, I suppose you might have a wife who's a really high income earner on the top marginal tax bracket, and the husband might be a stay-at-home dad, for example, and have no income. So you might look at, or he might have, a lower amount of income. He might be working part-time or something like that and being sort of one of the mid-tax brackets where there's some, a big differential in those tax brackets between mum and dad. So, if you've got a property that's something that's been just built, that's brand new, and obviously you guys are the experts in this area, there's, some really good depreciation benefits. So the property from a tax perspective could be negatively geared. And what I mean from a tax perspective is it could be negatively geared due to the depreciation. So, you can have a property that's positively geared cash flow. So you might have the rent that covers your interest and loan repayments and all your running costs and things like that. However, once you tack on the depreciation from a tax point of view, it becomes a negatively geared property that's a tax benefit to you. So, it might be something that you don't have to reach into your pocket and pay for each week. So it's cash flow positive. In that instance, there's some real, excuse me, some real tax benefits to structuring it in a way where you might have 90% of that negatively geared property in the higher income tax earner's name, because you're getting some of those short-term tax benefits that we mentioned before.
So the advantage of say having a 90-10 split and 90% being in the highest owner's name is good from I should say negative gearing point of view, because it'll lower their taxable income, which could drop them down a marginal rate. But on the back end, the negative of that would be they would be more liable to capital gains tax, right? So that's something that has to sort of be weighed up. How do you do that sort of analysis for a client?
Yeah, for sure. So I guess the discussions that I often have with people are, what's the strategy around this particular property? What are your goals with it? Is it a buy and hold strategy? And some of the questions that I generally ask Mike around, are you going to hold it to retirement? Is the plan to hold it for the next 5 years, 10 years? So you look at sort of the lifetime of the property in conjunction with the age of the individual, what their future plans are for retirement, how long they expect to work, all those types of things. I guess if you never sell a property, there's no capital gains tax, right? So some people often say to me, like, Woodsy, I'm hanging on to this property, I'm never going to sell it. It's going to be one of those properties that ends up with my children or something like that. So it's really, and it's hard sometimes because a lot of people don't typically think that far forward, or they might think that far forward, but sometimes they don't really know the answer either. Some people are super clear on it, and some people are like, yep, hanging on to it. It's just going to be an income generator for me long term. It's part of my super plan, part of my retirement plan. So, those conversations are super easy because you sort of look at more the short-term benefits to medium-term benefits tax-wise, and sort of give advice around that area.
Yep.
When you think about capital gains tax, I guess, you're then having two sort of discussions that offset each other. You're talking about sort of tax benefits in the short term from the negative gearing, and then you're talking, okay, well, if the plan is to sell it in 10 years' time, then there's a discussion around, if the property that you purchase is $1 million today and you sell it for $2 million in 10 years' time, then you talk around the structuring of that and what the potential capital gains tax implications are as well.
Yep.
So it's really like each property is, kind of a beast of its own in a sense. You're sort of talking different strategies for different properties and then different goals with each property as well.
Yeah, and I guess the decision on the entity would change whether it's the first investment property or the 30th, right?
Yeah, exactly right. And you start thinking, one of the big considerations around holding various properties, and land tax is a state to state tax, right? So thinking about New South Wales and the land tax threshold, if you had two properties in New South Wales that were investment properties, because principal place of residence being excluded, obviously,
yep.
Those two properties would, well, maybe one now, land value would typically tip you over that land tax threshold. So then you sort of start having some discussions around, is the individual's name the best name for those properties to exist in? Do you start to consider things like a discretionary trust where it may give you some more flexibility in terms of income distribution, particularly as you start to pay down debt on the property. So, you think about today and, you might have an 80% of the property is leveraged or you have debt for, you fast forward sort of 10 or 15 years, the net income from those properties, presumably if you're paying principal and interest, is sort of going to drop. So there's going to be bigger income distributions and bigger tax consequences on that as well.
Yep.
So typically, unless you're really risk adverse, and you had some significant risk in your personal name, that you wanted to protect that property from, typically people don't use a discretionary trust in New South Wales for that first property because, you pay land tax on every dollar of the value of that land. So, but certainly as you get to property 2 to 3, you start to have some discussions around, is there a better structure? Is it a family trust or a discretionary trust that might be better off to sort of own that property. And that gives you sort of, short-term distribution flexibility, but it also will give you some flexibility around distributions of capital gains if you were to sell that property in the future as well.
Yep. Now, as distinct from personal names, the discretionary trust will treat capital gains tax differently, and it will have a different marginal rate of tax. There's a different way that, say, negatively geared losses are treated, and then you've got the diversification of, I own one property in my name, another one in the trust, and I was going to be paying land tax on the second one anyway, so it's now better to have that flexibility. But apart from sort of the legal side of it and the I guess diversification of entities, what's the tax advantages or disadvantages in going to a trust rather than a personal name?
Yeah, so owning a property through a trust that is negatively geared, so that there's obviously losses on, whether that be from depreciation or just it's cash flow negative. Those losses are sort of trapped within that discretionary trust until there's some profits to offset those losses with. So ideally, you probably think the first couple of years, if it was a brand new property and there was lots of depreciation and it was negatively geared significantly, you're probably going to have some losses for the first couple of years until rents increase, until debt starts to be repaid and interest reduces. So that's always a consideration, because the losses from a discretionary trust can't be distributed to an individual. So you have some issues there, I guess, where it is negatively geared. On the flip side of that, if you've got a property that is paying for itself and the rent covers the expenses, I guess short term what it does is it gives you some flexibility around how to distribute that income. So you might have some kids who are adult beneficiaries who are 18 or older, who may be at uni, don't have any other income. You might be able to get some income out to them. The first sort of 20 odd grand is tax free.
Yep.
And there might be some significant tax savings, say in that instance, where it's not coming out to mum and dad, who might be at the top marginal tax rate. So in those instances, there can be some significant tax savings. So that's why I say, like, you sort of think that in terms of structure, you're always thinking, is it positively geared? Is it negatively geared? How many properties do they own? What are the short-term, long-term capital gains? There's like all these sort of competing, issues that people need to consider. So people often walk out and go, whoa,
Yeah.
I didn't really think about all those things. Yeah.
I was starting to wonder why you have more kids than me, but now I'm figuring, it's the trust distributions.
Well, there is a tax benefit to having, if you plan your children just to be born just before 30 June.
Right.
That's always a great time to have a child. But there's certainly, as minors, which my kids are, obviously, I've got 3 boys under 5. It used to be where you could distribute up to about $3,000 to each minor.
Yeah,
they changed the rules on that a long time ago. So, give or take, that $3,000 was, somewhere, around about $1,000 in tax savings for each child that you had, or, it could be a nephew or it could be a niece as well. So, these family trusts or discretionary trusts can distribute depending on the deed, sidewards and upwards and downwards. So they've reduced that to $416 per minor, which would probably save you about $120 or so in tax each year. So the savings are pretty minimal, and there's been some real recent talk around trust and some changes around some of the family trust distributions, which again is probably another podcast topic at some stage.
Yeah, and just running the numbers, I think a kid's going to cost you a little bit more tax saving. So those negatively geared losses, you can't sort of write them off your income in the year that they're incurred like a person can when you're in a discretionary trust, but they're trapped, but they stay there until there's a benefit in the future, right? But with the time value of money, it sort of begs the question, like, when is it better to have those losses? With the capital gains tax, you've got the 50% exemption for individuals. How does that work in the trust structure?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, so good question, Mike. The same treatment through a discretionary trust. If you own the property for longer than 12 months, you get that 50% general capital gains tax discount. And that discount flows through to an individual if you're distributing those capital gains through to an individual.
Yep.
So similar to the treatment as an individual, it's just passing through the discretionary trust where the discount applies and then applies to the individual. If you're distributing those gains out to, say, a proprietary limited company, you don't get the benefit of that 50% discount. And, that probably leads into talking about companies and, investment properties through companies, which is pretty uncommon, given the CGT discount isn't applicable.
Yep.
So owning property, an investment property or residential property through a company, you don't get that entitlement to that 50% discount that we just spoke about on capital gains tax. So I see a lot of investments in companies where you may have funds that flow through to a company, and that company may be an investment vehicle for sort of long-term property holdings. So I've got a few people who sort of tend to look at it and go, okay, well, I can kind of go, well, if I invest property in that company and I'm never going to sell it, or it's just I'm going to own it till retirement, and potentially never realise a capital gain on it, that entity can sometimes be used as a good investment vehicle where the funds sort of stay in that company and sort of tick around in there at a sort of a reduced tax rate as well.
I was going to say, and great segue, by the way, you're a better host of this show than I am.
Don't know about that.
Is that the real reason for a company? I mean, if you know that you're not going to incur a capital gain, it's a lower tax environment than it would be, say, in a personal name of someone on 100 grand, or let's say, a working couple on reasonable incomes with a discretionary trust. It's actually likely to be a lower rate of tax in a company.
Yeah, so it's a passive investment vehicle, so it's still taxed at 30%, as opposed to a business which has a tax rate of 25% for a company, a trading company.
Yep.
I guess some of the comparisons I use with people are, if you've got an individual who's on the top marginal tax rate, so earning over 180 grand a year, and they sell a property and they're entitled to that 50% discount. Well, the capital gains tax rate that they're effectively paying is 23.5%. It's at 47%, obviously at half of that. And then sort of you compare that to having a company which you get the certainty of paying tax at 30 cents in the dollar. So some people, depending on, risk, like I said, it comes back to that risk conversation. How comfortable are they to have it in their personal names? Some people might go, you know what, I'm going to use the company as my investment vehicle because I know that company is separate to everything else that I've got going on, whether it might be business or other risk or whatever that they've got in their personal name. So that's where people tend to use that company and go, okay, well, I know I've got some certainty around capping it at 30%. It's not significantly different to, the ability to cap it at 23.5% at the worst possible case.
Yep.
So...
And for the average punter whose maybe head is spinning listening to all of these
numbers
of tax. Now, of course, get a good accountant. That's probably the first bit of advice. But what's how do you get your sort of head around the fact that, okay, well, I'm looking at let's say it's my second or third investment property. I've got property in my own name, but now it's kind of getting a little bit more sophisticated where we need to start having the question, how do you sort of do that kind of discovery meeting with the client to figure out what's best in their circumstances?
You're right. Get a good accountant, Mike, because I think, or even just a lot of the times where, particularly property, like, once it's done, it's done. Stamp duty is a big cost to purchase property. So changing property structures is cost prohibitive.
Yep.
Those meetings generally, I just say to people, just make sure you talk to someone, like, have a conversation with an accountant or someone who's qualified so that you can get some good advice. And, we do those initial meetings and those fact find meetings for free as well. So I always meet with people and sit down and go, let's have a chat about what the strategy is. And obviously that turns into, they come back and we do their tax and whatnot. So we typically, I'll do like a discovery meeting, and typically it's a whiteboard meeting at my office. I'll talk to them about what their incomes are, what their future plans are. Are they planning on having kids? Is their income likely to change? What's their lifetime of work look like? What's their plans for retirement? How many properties are they planning on buying? Are they going to build a property portfolio, or are they just going to buy one, sell one, buy one, sell one? So it's really a discovery meeting, finding out, asking lots of questions around them, and how many kids do they have? Are they planning on having kids? Because obviously that factors into conversations around, not that I need to know whether they're having kids or not, but from a tax perspective, it's always good to know. Because that factors into the advice that you're sort of able to give people and guide them in the right direction in terms of what the best structure for them is.
Beautiful. And do people come to you and say, Dave, I just bought an investment property, and you think, oh gosh, like I wish you'd asked me first?
It has happened. Look, it doesn't happen with people who are existing clients because they know that they can reach out and have a chat over the phone or duck in. But sometimes you do see some shockers where it's really hard, Mike, because at the time the advice that they got may have been the right advice at the time. So I'm really conscious not to go, oh geez, I wouldn't have done that. Yeah. It's more about going, okay, well look, let's have a chat about what your plans are with the next couple of properties and how to structure those, because that might have suited at the time, but where you're at now, this is probably the best outcome for you guys, or the best structure. And I've actually got one at the moment, which is my auntie and uncle, and they were using a different accountant, and so we'd had some depreciation schedules that they had done by you guys, and basically what's happened is we've gone back to amend them with the ATO, and the tax returns have always been prepared on a 90-10 split because of the income disparities. And then once the ATO's come back and asked for the contract for the purchase, and from what we're now seeing, it looks like it should have been owned as tenants in common. So the accountant kind of got it wrong, and now we're going back to the OSR to try and have a battle that we hope we'll win to get the property in the right proportions based on a mistake that was done, without stamp duty. So don't know how successful that'll be. We've had one or two that have been successful, so fingers crossed. We'll see how we go.
Fingers crossed. You want those juicy tax depreciation. I'm sure we would have knocked that out of the park for you.
You did, absolutely. Mate, I think the best one that I had was a lady that you guys had done a depreciation report for, and new client. She owned a commercial property, never had a depreciation schedule, which was just absolutely nanas. Like, I don't know. And you just see it a bit, like it's, maybe just not a conversation or too busy or whatever, I don't know. We went back and amended 4 years because this lady had a family trust involved, and she got about 42 grand back per year. So like, this was a big building, big commercial building. And she rang me one day and said, oh, so how did I go? And I said, oh, you better duck into the office, because I wanted to say, of course. She almost fell off the chair. So it's pretty cool when you see the work that you guys do and the outcome of that as well. So
that's cool. I mean, we rely on people like yourself to give us that feedback sometimes, because, we'll come up with something juicy and we don't really know what it means to them in real terms, because we don't know their marginal rate of tax. But next time, let us know. We'll bring a bottle of champagne and be there for the big reveal. That sounds like a lot of fun. Yeah, I've learned a lot, and I've learned that I probably know a lot less than what I thought I did. And I think that might sort of resonate with a lot of people. But the best advice, I think, is to be getting good advice from an accountant, because I'm assuming that the difference between getting it right and getting it wrong, we could be talking significant amounts of money from a structuring point of view, outside of the risks of different entities, right?
Yeah, absolutely. Yeah, the risk of getting it wrong is can be literally tens of thousands of dollars. Like my auntie and uncle that I mentioned before, I did some calcs around doing these amendments for them, and we went back and argued the time period. It was going to be worth about 30 grand to them. So that, and that's only over a couple of years, Mike. If they own this property for another 10 years, it can be hundreds of thousands of dollars, and that's just talking about genuine short-term tax savings. When you start to think about capital gains and the impact of that, and what the tax benefits could be from having it structured differently, where they may have had no advice, the capital gains tax can be massive. It could be 100 grand in itself. So
Yeah, wow, that's awesome.
Yeah, so it's
Thank
big
you.
dollars for a little conversation.
Oh, exactly, and especially a free one that you mentioned as well. And I mean, even if it costs you $10,000, which I'm sure it doesn't, as a conversation anywhere, that can be money well spent. You're getting serious in your investment property portfolio. So, thank you very much for sharing all of that gold today, David. I really appreciate it.
No, you're welcome, mate. Thanks for having me on the show.
Cheers.
Good on you, mate.
That was great.
Awesome, mate. That was good.
Can I ask you one more question?
Yeah.
Which would be more of a like MCG plug sort of stuff. I've been meaning to do this for a while, but so that you have no chance to prepare, I'll just launch in. Let's just give it a go. If you're not happy, we'll do it again. But I like springing it on you because it keeps you young.
You tell, right?
That and the three boys. Yeah. So, David, as part of your accounting practice, you provide a free assessment of their tax matters, and you're using depreciation in, I think, an amazing way and an innovative way within the industry. As part of that kind of onboarding thing, you'll ask them what sorts of properties that they have. You'll send it through to us to get a free assessment of the potential tax depreciation deductions. And if they haven't had a schedule done before, then this can be an immediate sort of ticked box to say, David is better than my old accountant, not to put too fine a point on it, right? Are you finding that to be the case?
Yeah, Mike, definitely. Like it's definitely a really good intro to a new client, right? You're sitting there, you're reviewing, because we do a free tax review. So you're reviewing all their prior year financials or tax returns. And when you discover that someone hasn't had a depreciation schedule, you kind of just go, ching, you know, you're having a great conversation with them straight up. And they're kind of sitting there going, well, why haven't I had this conversation before? So, it's finding that info and having that discussion with them. It's really easy for us because, like you said, I email you guys the property and go, this is when this is the ownership. You guys come back and give me an estimate so I can quantify it to them and go, hey, look, last year if you would have claimed depreciation on this property, you would have got an extra $5,000 refund. We can actually go back and amend somewhere between 2 and 4 years worth of tax returns. So straight away, you're having great conversations with the client around, what we can do to minimise their tax or save them tax, but also physically get dollars back from the tax office in their pocket. Sometimes you're paying a couple of years worth of fees in advance just from prior year amendments as well. So it's it makes that you're sort of building trust straight away with the people that you're talking to, because they're going, well, you're having great conversations, like I said, and they think, what else have we missed? We want to make sure that we're on top of this stuff. So
exactly, and I suppose this sort of that begs the question, all right, if we've missed something that is quite simple, right, for an accountant and a quantity surveyor to work out together, what else could there be? And I'm guessing that there are all sorts of things that you can uncover that make a difference to their personal tax matters. But I'm assuming that that's a low-hanging fruit one. Like, have you got examples of where people just haven't had it done and straight away you can say, how's $5,000 back in your pocket sound in your next tax return?
Yeah, absolutely. There's been, it got to a point where I was actually super surprised about the amount of people with investment properties that didn't have quantity surveyors reports. And some accountants, it's probably a really old school way of doing it and probably not really cost effective either. But, you see where accountants have created their own depreciation schedules, and they might be depreciating stuff at 2.5% as a capital works, for example, like, construction or, new bathroom or whatever it might be. But obviously you guys pick the eyes out of that stuff, right? So you go through and go, okay, we've done a new kitchen, but hang on, the microwave is an immediate write-off, the oven's an immediate write-off. All these assets that they're getting a straight up tax deduction for that are otherwise being depreciated at 2.5%, which they may never see the tax benefit over 40 years because they may not hold the property for 40 years.
Yeah.
So by engaging you guys, and they fast track that, so they get more money in their pocket now. And like you said, with the time value of money, for us, tax is all about how do we minimise tax now and push anything out to a further date if possible. The benefit of getting those reports, and like I said, I don't know if this is common knowledge, so stop me if it's not. But you guys always say if we can't find the cost of the report in the depreciation benefits, well, you get the report for nothing. So it's a no-brainer, right? Like, I go to clients, well, mate, these guys will tell you, I'll quantify it for you. Here's what it's going to cost you. And they kind of look at me and go, Oh yeah, well let's do that then.
Yeah.
So easy combo.
Yeah, it's an easy product to sell when it's either it's going to give you more than what it costs or it's not going to happen.
Yeah, and then sometimes the question is, so do I have to pay for that report every year? Hey, this could be a business idea for you, Mike. And they're like, and I'm like, no, it's a one-off cost, and it's tax deductible, and you get to claim this depreciation year after year while you own the property. And they're kind of the people that haven't heard of them before, aren't aware of them, mate, they're shocked. Like they're like, wow, really?
Yeah. Well, I mean, we love working with you on that, and of course, that's free advice that we provide, and anything that gets the deductions for investors, we want to be a part of it. So we appreciate all the support on that.
No, you too, mate. Thank you very much.